Hello and welcome, this is Vince Stanzioni from indextrade.net. I want to spend the next couple of minutes explaining CFDs or contracts for difference. They've been around about 12, 13 years, but they've become quite popular, especially in Australia and parts of Europe, where spread betting either isn't allowed or isn't as popular as maybe the UK. But in many essence, they're very, very similar to financial spread bets or financial spread trading. So I'll go through just quickly a little presentation with you. CFDs, as I say, they're available to clients in Europe, Scandinavia, the Middle East, South Africa and Australia, to name a few. Now, you can also trade CFDs in the UK. However, most of my clients don't use CFDs in the UK for one simple reason, is the tax. They use financial spread betting because it's tax-free. But many of these systems and advantages, other than the tax, between CFDs and financial spread betting is very, very similar. And in fact, many of the companies, for instance, like IG Index and IG Markets, they're the same companies, so they trade CFDs and financial spread betting. So what's the concept of CFD? Well, if you're used to buying and selling shares or trading other markets, then CFDs shouldn't be too difficult to grasp. The bottom line is the main difference between a CFD and you buying your physical shares is with a CFD, you don't actually own any shares. If you can imagine, it's a trade, it's a contract based on the price of something else. So let's say, for instance, McDonald's shares. If you go out and buy McDonald's shares, you own McDonald's shares. But if you trade a CFD on McDonald's, it's a bet basically on the price of McDonald's. And you'll say, well, what are the advantages of doing that? Well, we'll go through it and you'll see one of the main advantages, which of course is leverage. So really the contract will mirror whatever the underlying market, so whether it's McDonald's, gold, whatever you've placed your trade on. And as I say, the CFD, the contract, is between you and the company. So IG Markets, Saxo Bank, the variety of companies that trade CFDs, that's the person that, that's your counterparty. Obviously, it's important that you're careful with who you choose as your counterparty, because at the end of the day, if they was to go out of business or something, then your trade would be void and you could lose your money. So here's an example of a CFD, and remember, with a CFD we can easily go short as we can go long. Traditionally people are taught that make money from things going up. Well, that's great in a bull market, but we can also look at making money from things going down as well. So the main difference that with a CFD is, think of it a bit like a loan or a mortgage on your house. Instead of having to put all the money up, with a CFD, we only have to put a fraction of the amount up, a deposit. And that's basically, it's called a margin product. So let's say, for instance, instead of buying 10,000 euros or $10,000 of a stock, and having to pay that whole amount of 10,000, normally you only have to put about 5 to 10% of that amount up. Now, the good thing obviously about a margin product is that it's margin, so your gains, your money can go a lot further. Of course, there's also a negative side to margin. It's important that you check your risk, is that when you're margined, the gains are amplified, but so are the losses. But the good news is there are a lot of things like stop losses and orders that you can place to make sure that you limit your risk. So as I say, give margin respect. The other thing is, what I say sometimes is it's like a speed limit. You don't have to drive at the maximum speed limits. Although you may be offered quite a bit of margin, you can actually not have to margin up to the limit. You can margin less. So an example of margin, XYZ are trading at 10 euros per share. You can go long buying 1,000 CFDs at $10. You now have the equivalent of 10,000 euros worth of shares, but you haven't had to put 10,000 euros up. Normally your margin requirement is about 5%, so we've only had to put 500 euros up, leaving our other $9,500 to use for other trades or for other purposes. 2 months later, the share has moved up to 12 euros and we now close out, so we've now made 2 euros per share. Now, of course, that's the same if you also bought the share, but the difference is that we've made 2,000 profit, less any interest costs, because remember, there's a charge because you're taking out basically margin, you're taking out a loan. But right now, interest rates in Europe, UK, US, most countries, rates are fairly low, so margin costs are relatively low. Also, some CFD brokers will charge you commission as well. With shares, if there is a dividend that's payable, you are entitled to that dividend, either a percentage of it or all of that dividend. But if you're short, remember, if the company pays a dividend and you're short, you own, so you'll be debited for that amount as well. There's a variety of orders. You know, a lot of people think, oh, CFDs are just for short-term traders, but really they can be for long-term traders, and you don't have to be stuck to a screen all day long. In fact, you know, if you place an order or stop order or a limit order, you know, you can just go about your normal business and not have to worry about your trade. You know, let the broker basically do the work for you. And all this, by the way, can be done online. Right now, most CFD, you know, brokers will take trades via phone, via internet, and even things now like iPhone and some, you know, the smartphones, you can place your orders via those as well. A guaranteed stop loss, not offered by all CFD brokers, but certainly some of them will do. It literally means that it's guaranteed. So whatever happens is your risk will be the maximum. So let's say, for instance, I'm trading $1 a point and my stop is 100 points away. Well, my maximum risk there is $100. There's a great and wide range of markets that you can trade. There's international individual shares. There's global stock indices, exchange traded funds, so you can actually place a CFD on an ETF. Currencies, you can trade the major currencies via CFDs, and of course you've got the benefit of the leverage there as well. Commodities, all the popular ones like gold, oil, wheat, plus some of the not so followed one again, all can be traded via CFD. Bonds, not one of the biggest markets for most people, but you can trade bonds as well. Precious metals, obviously gold, platinum. So summarising the CFDs, this transparency, you know, a CFD basically mimics the price of the underlying market, you know, less a little bit of broker spread. There's no time limit. A CFD doesn't expire. In theory, you can run it for as long as you want. However, remember, if a CFD is going against you, you will have to put more margin up. Remember, you can trade long and short, the opportunity to profit from falling as well as rising markets. And I say you can trade a variety of different markets. You know, remember, a lot of people based in the UK or US or Australia, you know, they think that that's the only market. Of course, there's plenty of other markets as well that you can be trading. Flexible orders, you don't have to be stuck to a screen all day. You know, as I say, you can place orders, place limits, place stops. No minimum trade size. This is great because if you trade in the futures market, normally you have to trade in round lot sizes, whereas with CFD brokers, and especially it's quite competitive at the moment with a lot of CFD brokers, they'll allow you to trade as little as one CFD. So you can trade very, very small, and obviously you can trade large as well. Anyway, to learn more about CFDs and financial spread trading, just go to my site, indextrade.net, www.indextrade.net. You'll find more details about my course, Making Money from Spread Trading. Hope you found this interesting. Thanks for watching.